There's a $2 trillion time bomb sitting inside the American financial system right now, and it's been built using accounting tricks that would land an ordinary person in federal prison. It isn't hiding in plain sight, like the mortgage-backed securities of 2008. It's operating in the shadows, literally, inside something called the shadow banking sector. And by the time most people notice it, the damage will already be done. Let's start there, because this is the mechanism that makes everything else in this story possible. The shadow banking time bomb. After the 2008 financial crisis, lawmakers passed the Dodd-Frank Wall Street Reform and Consumer Protection Act specifically to prevent the kind of reckless, opaque lending that nearly took down the global economy. It was designed to end too big to fail, stop taxpayer-funded bailouts, and protect ordinary consumers from predatory financial practices. In practice, it didn't eliminate any of that risk, it simply pushed it into a part of the financial system with far less sunlight. That part of the system now prefers a softer name, non-bank financial intermediation. The Financial Stability Board defines it, somewhat clinically, as credit intermediation involving entities and activities that sit entirely outside the regular banking system. Outside that system, the regulatory guardrails that apply to traditional banks simply don't exist in the same way, and an entire industry has grown up specifically to exploit that gap. This is the engine behind the explosive growth of private credit. Where companies once went to regulated banks for loans subject to strict oversight and capital requirements, private credit routes that same lending through off-balance sheet arrangements between non-bank entities, largely invisible to public scrutiny. Here's the part that should genuinely alarm you. Traditional banks haven't stepped away from this lending. They're still deeply involved, just indirectly, quietly providing financial backing to the private lenders who do the actual deal-making. Dodd-Frank forced regulated banks to hold more capital and conduct more rigorous borrower screening, which slowed lending down and made it more expensive. Private credit sidesteps all of that friction entirely, and unsurprisingly, the industry has exploded as a result, now sitting at roughly $2.1 trillion and projected by BlackRock to balloon to $4.5 trillion by 2030. The core danger isn't just the size of that number, it's the near-total absence of transparency behind it. A finance professor at the University of Cambridge has put it bluntly, nobody actually knows the true value of the assets these firms are holding. The industry is opaque by design. There's a hope that no serious bad loans are buried inside it, but hope isn't a risk management strategy. Part of the reason nobody can answer that question with confidence comes down to how these loans get valued in the first place, a method called mark-to-model. Rather than pricing assets against actual observable market transactions, firms plug assumptions into financial models to estimate value. That means a massive slice of the American credit system is being priced not on hard data but on educated guesswork made by the very institutions with every incentive to guess generously. The zombies holding up the economy. That guesswork has produced something genuinely strange, an entire class of companies economists literally call zombies. Household names like Beyond Meat, AMC Entertainment, and Sunrun fall into this category. A zombie company is one that generates barely enough revenue to cover the interest on its existing debt, let alone pay it down. To survive, it has to take on new debt just to service the old debt, creeping closer to insolvency with every passing quarter while technically remaining alive on paper. According to Deutsche Bank estimates, as much as 18% of publicly traded US companies fit this description. That's not a rounding error, that's nearly 1 in 5 public companies functioning as financial deadweight. It would be tempting to say these companies should simply be allowed to fail and clear the system. But as of 2020, zombie companies collectively accounted for roughly 2.2 million jobs in the United States, a number that's only grown as inflation has pushed borrowing costs higher across the board. Many of these companies now rely on something called payment-in-kind arrangements, PIK for short, to limp along. Instead of paying interest in cash, that interest simply gets rolled into the total outstanding debt balance owed to creditors. It's a financial trick that makes the immediate crisis disappear from the books while quietly making the underlying debt mountain larger and more dangerous. It virtually guarantees a slower, more drawn-out collapse rather than solving anything. The private credit industry has every incentive to keep this arrangement hidden behind a curtain of calm, because acknowledging it openly would mean admitting a meaningful chunk of the economy is being propped up by financial fiction. The 9% secret hiding inside official inflation numbers. While corporations quietly extend and pretend their way through zombie debt, ordinary households are dealing with a very different kind of financial fiction, the official inflation rate. Governments love to point to the headline Consumer Price Index as proof that inflation is under control and the economy is fundamentally healthy. In 2023, the official CPI for all urban consumers came in at 4.1%. Sounds manageable, right? The Ludwig Institute for Shared Economic Prosperity didn't think so. They built an alternative measure called the True Living Cost Index, or TLC, specifically designed to correct for a major distortion baked into the standard CPI. Remember that wealthier households spend a disproportionate amount on discretionary non-essential purchases, the kind of spending that tends to stay comparatively stable even during inflationary periods. The TLC strips almost all of that out. Instead of tracking more than 80,000 individual items, many of them irrelevant to how working-class families actually spend money, it focuses narrowly on the essentials: housing, food, transportation, healthcare, childcare, technology, and basic necessities like clothing. Once you make that adjustment, the picture changes dramatically. Against that same official 4.1% CPI figure in 2023, the True Living Cost Index came in at 9.4%, more than double. That was the sharpest annual increase since 2001, a year that sat less than a decade before the 2008 financial crisis and right at the start of the Iraq War. Hardly a reassuring historical comparison. The Institute's own researchers describe middle and working-class Americans as facing a deepening economic crisis, one where the combination of rising living costs, stagnant wages, and a shortage of jobs that actually pay a livable wage is creating conditions that genuinely threaten broader social and economic stability. And critically, this is a risk the government and banking sector appear entirely willing to keep gambling with, because it isn't their chip sitting on the table. It's yours, where all the spending power actually went. The result of that gap between official and lived inflation shows up starkly in who actually controls consumer spending in America today. As of 2025, middle-income households account for just 28% of total U.S. consumer spending, down sharply from 37% back in 1992. Meanwhile, the top 10% of earners, households making over $250,000 annually, have absorbed nearly all of that lost ground. Their share of consumer spending has climbed from 35% in 1992 to 48% today. Sit with that for a second. Roughly 1 in 10 Americans now controls close to half of all consumer spending nationwide. That's not simply an advantage. It's near total economic dominance. Working-class households have it even worse, now representing just 9% of total consumer spending power, less than a tenth of the entire economy. Moody's Analytics chief economist Mark Zandi has stated plainly that lower-income households have seen their share of the economic pie shrink, and that trend shows no signs of reversing. The system is actively transferring economic power upward in real time, quietly, without a single dramatic headline event to mark the moment it happened. Why the housing market hasn't collapsed yet? Here's where the story gets genuinely counterintuitive. If purchasing power for the bottom 90% is collapsing this severely, conventional economic logic says the housing market should be one of the first dominoes to fall. Historically, that's exactly the pattern. But it hasn't happened, and understanding why reveals one of the more clever mechanisms keeping the system looking stable on the surface. You've probably heard that high interest rates should crash home prices over time. Higher rates make monthly payments more expensive, which should reduce demand, which should eventually create a surplus of unsold homes and push prices down. That's sound economic theory, unless the available supply itself gets frozen in place, which is precisely what's happened. During the pandemic, mortgage rates hit historic lows, allowing millions of buyers to lock in extraordinarily cheap long-term financing. As of the second quarter of 2025, over half of all existing mortgages, 52.5%, carry an interest rate below 4%. New mortgage rates, by contrast, jumped past 6% back in 2022 and have stayed elevated ever since. That gap creates a powerful disincentive. Homeowners sitting on a sub 4% rate have almost no financial reason to sell and take on a new mortgage at nearly double the cost. This phenomenon has a name: the golden handcuffs effect. It's genuinely beneficial for the individual homeowner locked into a great rate, but it completely destroys the incentive to sell, effectively sealing off the market for everyone trying to buy in. The Federal Housing Finance Agency estimates this lock-in effect alone prevented approximately 1.72 million home sales between 2022 and 2024. Because so few existing homeowners are willing to sell, total housing supply has fallen to at least 14% below pre-pandemic levels, even as demand has softened. Reduced demand should logically push prices down, but with supply this constrained, prices are instead staying artificially elevated. Homes are also sitting on the market longer than they used to, averaging 62 days in late 2025, roughly a week longer than the year before. As one chief economist at a major housing data firm put it, markets with the tightest available supply keep seeing the strongest price growth regardless of how badly affordability has deteriorated for buyers. Whether you're locked in with a cheap rate you'll never give up, or locked out entirely because there's nothing affordable to buy, the net effect is the same. The broader public is functionally frozen out of the housing market, and that frozen market is exactly what's masking deeper cracks in the wider economy. Two different economies, one country. Step back and look at the whole picture, and a much starker divide comes into focus. The S&P 500 is sitting near record highs. But according to Fortune, current mortgage rates near 7% mean you effectively need a six-figure income just to afford a median-priced home, which now sits around $422,000. Meanwhile, Federal Reserve data shows the average savings balance for Americans under 35 is roughly $20,500, and because that average gets heavily skewed upward by a small number of extremely wealthy young people, well over half of young Americans actually have significantly less saved than that number suggests. The math underlying home ownership has quietly transformed. The median home price to income ratio in America climbed from 3.5 in 1985 to 5.0 by 2025. In 1985, buying an average home was roughly comparable, in relative cost, to buying a nice luxury car. Today, that same relative burden looks more like buying a private jet. Inflation compounds this divide rather than spreading evenly across it. Data from Allianz shows prices have risen 29% since January 2019, with a persistent 3 percentage point inflation gap between low-income and high-income households, meaning inflation genuinely hits poorer families harder. Every single year, 1 in 3 low-income households now spends approximately 95% of total income just covering basic necessities. Because so much of measured inflation is driven by essentials like food and fuel, the households spending the largest share of their income on exactly those categories absorb the most damage. High-income households, by contrast, direct 16% of their spending toward purely discretionary goods and services, spending that can be trimmed or delayed without real consequence, compared to just 12% for lower-income households. The categories that stay most stable during inflationary periods are disproportionately the categories wealthier families can actually cut back on. Everyone else absorbs the full impact. Living what used to be considered a normal middle-class life now effectively requires an elite-level income. A K-shaped economy, split along generational lines. All of these forces converge into what economists now call a K-shaped economy, a system so lopsided that outcomes diverge sharply depending on which side of the K you're standing on. One line rises, driven by asset owners riding record stock and real estate values. The other line falls, populated by people deciding day to day whether to fill their gas tank or their refrigerator. This divide is heavily generational. Baby boomers currently hold $83.3 trillion in assets, more than half of all household wealth in the United States, averaging roughly $1 million per person, making them the wealthiest generation in modern history. Millennials and Gen Z combined represent the largest population bloc in the country, yet together they hold just $17.1 trillion, only about 10.5% of total national wealth. These younger generations are also carrying forms of hidden debt that older generations never had to navigate, including the explosive rise of buy now, pay later financing, an entire shadow layer of consumer debt that doesn't even show up in standard federal reporting. What you can actually do about it. None of this means there's nothing worth doing. If you want to position yourself ahead of further deterioration, the priority shifts from chasing growth to building resilience, protecting whatever capital you have from both inflation and the kind of institutional instability described above. Gold remains a classic inflation hedge, though it's worth being honest about its limitations. It generates no yield, so during periods when interest rates rise to combat inflation, gold can actually underperform interest-bearing assets in relative terms. Broader commodity exposure, grains, precious metals, energy, agricultural products, offers another option, though commodities are notoriously volatile even outside inflationary periods, since their pricing is extremely sensitive to geopolitical shocks, and geopolitical shocks haven't exactly been in short supply lately. For a more conservative approach, a traditional 60/40 stock and bond portfolio remains an option, though historically this mix has significantly underperformed all equity portfolios over long time horizons. Real estate investment trusts, or REITs, offer indirect exposure to the property market without needing to buy a home outright, generating dividend income, though they still carry exposure to property tax changes and shifting demand for competing high-yield assets. As with every investment decision, there's no such thing as a genuinely risk-free option here, only a choice between different flavors of risk. In an economy that increasingly rewards asset ownership over labor and quietly punishes anyone without existing capital, the priority for most people isn't maximizing growth anymore. It's surviving the transition long enough to get on the right side of that widening K before the window to do so closes entirely.